None of VPM Partners, Bob Kendall, or any of its officers, directors, employees, other personnel, representatives, agents, or independent contractors is, in such capacities, a licensed financial advisor, a registered investment advisor, or a registered broker-dealer. None of VPM Partners or its personnel gives investment or financial advice or makes investment recommendations, nor are any of them in the business of effecting trades or directing client equity accounts or giving futures trading advice tailored to any particular client situation. Nothing contained in VPM Partners broadcasts, on its websites, or in its written materials constitutes a solicitation, recommendation, promotion, endorsement, or offer by others described above of any particular security, other investment product, transaction, or investment. Copyright 2014 VPM Partners. All rights reserved. Terms of use apply. Reproduction, adaptation, distribution, public display, exhibition for profit, or storage in any electronic storage media in whole or in part is prohibited under penalty of law.
Good morning, everyone. It is Friday, and markets are still in the same range they were when we were on Monday, I think, right, Mitch?
Yeah, pretty much.
Anyway, today we're going to cover, I mentioned in commentary, and I've been kind of harping on this for a little bit, is that we're going to start looking at some of the deflationary pressures and talk about some of the things that are happening around the planet. There's quite a few things. It's an interesting time that we're in here. There's just a lot of cross currents, what would appear in our minds anyway, to start to formulate a lot of risk that's out there. And so last night doing commentary, Mitch and I were talking about it. I was grabbing at straws, actually. It was like I had to get philosophical to fill in some ideas, and we'll talk about some of the things that are going on from the standpoint of some of these currents that are in the marketplace. And I've watched a fair amount of European TV on the Scotland issue, and it's sort of interesting. It's I think it's up in the air how it plays out, but it's interesting that some of the big banks, Lloyd's and you got a Bank of Scotland, you would think our Royal Bank of Scotland, you think would be Scotland. Well, it was interesting because during the crisis and the banking crisis, the UK took a huge position in that stock. They basically took over. So it's UK owned, even though it says Bank of Scotland. So somebody said Bank of what? So they're threatening to move out of Scotland should they get a yes vote, which is kind of interesting. So the Bank of Scotland would be in London. But anyway, and not their headquarters. They'd probably have operations, but there's a lot of ramifications of this particular vote, and the separatists around the planet are watching this thing really, really close to see if there's some things. There's in Barcelona. There's some things going on in Spain. There's a lot of little currents out there that are flowing, and certainly the most recent Russian acquisition with Crimea. That was another separate move, and there's a lot going on here, and from an economic standpoint, and the people in London are kind of freaked out, to be honest with you. There's a lot of things that are happening there, and so anyway, we'll be looking at those things. Here in the U.S., it's about like watching grass grow. I mentioned that we're hoping that the dog days would be over, but somehow they keep hanging on. It feels the same as it did 3 weeks ago, 4 weeks ago. We've been in this same range, and at least now, of course, we've seen this pattern every day. I think this week, markets down early in the session, and we rally back to close on change or not as bad as it was, and we keep getting back toward that 2000 level, but it doesn't seem to go above it lately. So we're staying below it and ending up back around this 1990 level. I don't think I mentioned this number, but we'll go through in the technicals some of the aspects of the markets themselves and what's a key number there. I did mention the 1990 50 number, but 93.60, anything below that today is going to be negative to a point. we'll see. We're 98.01 right now, down 944 on the S&P. So we'll see how that plays out. So we had a couple reports today. We had retail sales, right, Mitch?
Yeah, we had retail sales come in. Consensus was anticipated to be at 0.6%, and that's exactly what it came in at. We also had consumer sentiment. In the case of consumer sentiment, consensus was 83.4, actual was 84.6. So this beat expectations. What I found was interesting is if you look at the history of this puts us almost right on to where we were back in September of 2007. In fact, I was telling Bob earlier that when the consensus first came out at 83.4, that was what we had in September of 2007. So we're getting right back up to that same level we were prior to the last crash, after we've had such suppressed sentiment leading up until now. So it's the highest it's been, I think, in something like 14 months.
Yeah, and I always have a question about these reports that are, survey based anyway. So
right.
You just wonder, sort of like watching a gymnastics match. They get 7s and 8s, and it's all an opinion. So it's not as good as it normally would appear anyway. So.
Yeah, 'cause it's not based on facts. And one of the things we mentioned, I think, last week was that the actual index-based stuff that's based on actual facts and data, that has been coming in mostly below estimates, whereas all the sentiment stuff, all the things that are based on opinions, that have been higher than expectations, which is sort of this interesting dichotomy.
Yeah. It's like anyway. So moving on from. As I mentioned also in commentary, none of these reports were likely to be that impactful. I think what we're seeing here is the market's really starting to get tired. Maybe they're as tired as I am of 2000 or hanging around here. But there's just nothing to, as I mentioned, there's more risk on the downside right now than there is on the upside. There's just no, you can't come up with a good scenario to get these markets to rally right now. And there's just, like I said, all of the things that are going on, everything from Scotland, we didn't even mention the Ukraine, with the situation with the ISIS and all the different cross currents that are out there. I suspect that Mr. Putin is probably, I don't know if he's laughing or not, but he's certainly rubbing his hands together like now he gets to do whatever he wants to do. The U.S. seems to be focused on other things, and they're sanctioning banks and stuff, and really what's happening there is the Russians are hooking up to use the yuan as a currency, and they're just forcing more people to go away from the dollar. So it's funny because all the sanctions so far has hurt Europe more than it's hurt Russia. So I'm not sure how it's going to work out. I always say it's like the unions go on strike, all the workers get hurt, but the union leaders are still enjoying their steak dinners at night. So just the folks that are sacrificing it at the bottom end. So same type of situation here. So let's move on to the markets here and see what's going on. So evidently, if the background music's still playing or something, I'm not sure.
Yeah, we just got a tweet that sounds like the Market Thunder background music.
Nice.
Still going.
That's very nice. I'm not sure why it's doing that.
Get that cleaned up.
So let's go ahead and see if we can get rid of that. And let me go over here. And this should fix it, I hope. I'm not seeing the... Yeah, it looks like it's probably fine now. I apologize if that's the case. I'm not sure what caused that. Same screens we always use in our studio. But anyway, looking at... here's the daily S&P, and boy, this thing is as flat as a pancake as far as that goes. We're looking at the down to 857 here on the index right now. But this is something I talked about day before yesterday on the commentary, and you can see it here where my cursor is. And let me just draw a couple things here just to show you what is going on here. But there's some new objectives here that have popped up. There's 3 of them, and they're downside objectives. There is no upside objective right now from the VPM rangefinder or Fibonacci projection tool, and there are 1924, 1891, and 1871. So we've seen before where these big extreme over here putting some more arrows over here. We've seen these type of patterns punch up to 4, and they last for a couple of days and they go away. This one will stay in play if we can get through around the 19, as long as it stays below the 2002 level, and it goes below the 1981 level. That will be the key pivot number, and then these numbers will come in play. So 1924, and then going down to 1881 to 1891, and we'll talk about this because this puts us in play with the monthly, some of the monthly numbers that I talked about before. So these new objectives are driving the markets right now, and when we look at the PPMs here, let's see if I can get to the right place. We look at PPMs, we're minus 0.4, plus 10, 1.0 or 0.10, and then 0.03. So all of these averages have no momentum on them, which suggests that they are very vulnerable to a penetration, and those values are right now we're below. The sound is back on there again.
Yeah, it sounds like the music is popped back up.
I have no idea why that would happen. Okay, bear with us 1 second, folks. Okay, so we can see if we can get this to fix.
The joys of live broadcast. Sometimes technical difficulties arise.
Yeah, I need silence just for a second so I can see what's going on here. It's really strange. I don't know why. It does appear there's some kind of sound in the background. I can't seem to get rid of it. That's very annoying. Hang with us 1 second, folks. One of our first big glitches. I've never seen this happen before. I have no idea what's going on. All right, that was almost as good as a crash. So I'm back and talk about breaking the momentum, but I think we got rid of that. I really apologize. I've never seen that happen. We've done almost 60 of these shows, never seen that one happen before. Anyway, getting back on track here, these downward objectives that are occurring here are really about the pattern that's emerging from this sideways movement. And we're starting to see all of the characteristics that we see in what we call a crossover. So if you roll back to July when we had the big decline, we traded down, we went through all three averages, we rallied back. I think we dropped 4%, rallied 6%. Now we've been sideways again. And most of the rally back 6% had to do with the geopolitical risk kind of dissipating, or at least people stopping to worry about it or make it as a key factor. So we basically got back to the highs here, and now it's you got to show me the money here and show me what's next as far as the patterns to unfold here. But we're seeing momentum really starting to drag down. So let's go over to the weekly chart here so we can take a look at this. And on the weekly graph, we're seeing the same type of momentum. We're flat. Let me bring this numbers up so you can see it here. We're 0.02, 0.031, and 2.4. So as I've talked about on Monday's show, nothing's really changed from this. We're on the very short term. There's a support around the 1972.50 level, which is the 10-week moving average. And this is going to be the pivot point. Once it gets through that level, then we're going to see it move down toward 1944, and then the number that was on the Fibonacci, the 1924 level. So there's going to be some pretty good potential for the downside. Right now, and we'll see how it comes out on Monday. Monday show, we'll have a really good feel as soon as we see the first tick of Monday, what's going on with this momentum. I suspect that the momentum is going to start to die off on the PPM2, which is currently the 0.31. It's 0.25 or greater, remember, is a trend. And as long as it's above that, then there's about a 60% probability for the value of the moving average. So in this case, 1944, call it 1945, is likely to hold any market decline to that point while it's over 0.25 or greater. So it'll be more or less the trend line. And moving averages are, for me, dynamic trend lines. And the key is to a trend line is trying to figure out when it's going to be broken and when it's going to hold. And as these numbers, the beauty of measuring what I call the angle of attack of these moving averages is you can get a very statistical feel for how these numbers are going to hold. Right now, if we traded down there, you'd want to be a buyer that would probably bounce off of that number. But for now, it's not there. By the time it does get there, there's a very good chance that the momentum will be under 0.25. So we'll have to see how this unfolds, like I said, next week. But for right now, the short term is very vulnerable. It's very likely we could see the market down to the 1972 early next week. Mitch and I were talking about offline right before the show came on, and the S3 on the weekly projections, if you look at Monday's commentary there on there, is 1989.40. We're trading 89.55 right now, so we're trading right at that level. And we went just below the extreme for the week, which was 1983.70. And we traded below that for a second. I think 82.90 something was the low, if I recall. Matter of fact, I think probably right here on the screen. 82.92.14. So it was right. That's today, isn't it? Let me see if I can get to this number here. Yeah, so that's the moving averages. So I got to go up here a little bit. Yeah, 82.99. So it was just a touch under that number. So we've come down to the extreme for the week. If we manage to close lower, I'm going to go to the futures real quick here because there's some things happening intraday that, we've seen this pattern: weakness in the morning, rally in the afternoon, and that keeps unfolding. We talked about that just a few minutes ago. That pattern, if that breaks today, then we could see this thing close under this 1990.50 would be really, negative, at least from the standpoint of seeing some of these numbers I'm talking about right now. That's 1972. We should probably see this thing to fade off. And it's very easy for the market to get some momentum here. I mentioned also in commentary, sorry if I'm the LPL guys, but your guys are joining the bullish fans. You got Morgan coming out talking about 3,000 S&P. LPL came up, I think the 3 R's, I forget, it was revenue, reinvestment, and something else. But it's a whole theme why the market's just going to go up forever. And it's starting to feel more like 2000 almost than it is in 2007. It's just that there was a feeling back in the days, I guess the .com thing. It's not as crazy from an industry or all of the IPO activity that we had then, but there is this euphoria that the Fed, in this case it's the Fed, is going to keep this market going up forever. And there seems to be a lot of complacency. And I don't know, I turned on CNBC for a little bit yesterday, and it was just one after another, one mutual fund salesman after another telling how the market's going to go up forever. And it's funny because they brought on a guy that was, I guess whenever the market was down, they had him on, and he said, well, the market's going to go up, but he always says it's going to go up. So it's like the broken clock thing, right? It's right, twice a day. And all these folks, a lot of these people that come on there, they're always bullish or they're always bearish. You got the perma bears, you got the perma bulls, and then they bring them up, and they like to bring the guy up when the market's up that's always bearish so they could call him wrong. Harry Dent's a classic one where he's been bearish, I think, since 1941. He just kind of keeps going bearish, and the world's coming to an end and all that stuff. But the bottom line is these guys are even bearish all the time or bullish all the time, and there's not a lot of flexibility in their commentary. But the overall patterns that are unfolding here, from my viewpoint, are starting to show some really significant moves on the downside. We're going to go to the monthly graph here, and I've been harping about this, and I'm pretty excited about what's happening here because we're finally seeing the signs. PPM1, bringing that up on the screen here, PPM1 is 0.97. It's below 1% for the first time for a very long time, actually, going back to 2012, since it was below this level. And this is the very beginning signs. And what this is, these PPM 1, 2, and 3, they're tracking the 10-month moving average, the 21, and the 40-month moving average. And they're looking at the rate of change and then the first and second derivatives of those rate of changes. And so this goes to that angle of attack thing that I was just talking about. And the angle of attack is starting to fade, and the average now is 1905.37, which is the low of last month, if you recall, 1904 and change. So it's very possible once we start to see this thing fade. This may not be until next month, into October. We're about halfway through this month here already. But next month in October, we'll probably see these lower numbers challenged. And I talked about this over the last couple shows, is that I expect that this 1905 number has to be retested. And I also suspect that it will go through that level, but there is some pretty substantial support at the moment because of this PPM1 is at 0.97. That value is at 1905. There's going to be some support there, and also because it's a long-term number, it's going to be at the meaning that it's going to take several more bars for this to get at a low enough level that the market's going to decline below that. So if we get down to 1900, we may be stuck in a 1900, 2000 trading range, depending if there's no news to drive us further and force it through those averages to make these indicators turn a little faster. But for right now, there's going to be substantial support down at 1905, and we'll have to see how it plays out when we get there as far as the patterns go. I was talking to Mitch yesterday. I think we were Skyping back and forth, but I said a lot of times it's not the price of what the market is, it's how it got there as a lot, and market structure has a lot to do with things. And the structure that we're seeing here on a monthly graph is really important to understand because we're seeing the very first signs. I'm going to say that we're somewhere between 1 and 3 months of a major top here. And I think this thing's going to fade substantially. That it could still spike. There's still valid upside projections at 2034 and 2072. So there's certainly some probabilities. But you start looking at that, that's what, maybe a 3.5% rally. It's really nothing. And the downside here on this chart that we're looking at right now is to go back and test that 21 period moving average, which is all the way at 1763 right now. It is rising at 1.5% per month, so it's a pretty substantial support. But you start figuring out if we were to get to 1763, that's a pretty good decline. And on this chart, it will be, if we hit that, it'll just look like another blip on the chart, but everybody will feel that one if we get there for sure. So from the index standpoint, I want to go over and take a look at a couple things here. Here's the 24-hour futures chart that I usually bring up. The 5-minute came in with a nice cycle, and we're retesting that low. So if this low holds, this next cycle that's coming out, which is about an hour and a half, 2 hours from now, will be a top cycle, and then there'll be another retest. So there's a chance from a very short-term basis that we're going to see this market stay under pressure for the rest of the session. There is one other event that's happening here in, see how many, next hour there is a cycle due, but two things have to happen for these cycles to be valid. Is you need this swing index down below here, this bottom indicator. Let me get out of the way so you can see this. But this swing index, you want to see these spikes like we did over here. You want to see here's a big spike down. It doesn't look like we're going to have that, so it looks like this this cycle that's coming in next hour is going to be a dud. And so there is, for the first time in the last several days, there's a pretty good chance, unless we get some activity here in the next hour, that this market's going to stay under pressure today and it won't bounce back. So that was one of the things I want to look at. The other charts to look at, which I think are significant here, I'm going to try to get this in a view that you can see well, is these are the webs on a weekly basis, and it appears to me that this thing's rolling over, and there's quite a bit of probability for this to roll down. 1944 is the 21-week moving average, and 1892 is the 40-week moving average. This is the weekly, and it's very likely we're going to see this 1905, as I mentioned earlier, tested and see this market move down below that level, and then we'll see what type of momentum gets into play. And we did see this, the VIX down here. This is the orange graph right here. It's currently at 1332, so it's up about 4% today, up 52 cents. This index got to an extreme. Everything lined up that there was just nowhere to go. It was a brick wall. So that's why we traded around the 2000 level. So we had multiple closes, 2003, 07. We printed up at 11, but we couldn't hold these numbers. And each time we held above 2000. And of course, the talking heads on CNBC were parading around, yay, look, we held 2000, it's resilient, and all those kind of things happening. The reality is, this is what I'm talking about, it's the structure of the market that tells you a lot. And you can see each time that these webs have gotten to this pattern, we have had little minor tops. One of these gets to be the big one. I don't know which one it is, whether it's this one or not, but that's what happens. On a short-term basis, you'll see this is another view, and you'll see that the short-term basis, we're right on some support right now at this 1988 level, 86 level is some support. Below that, we're looking at once again 1972. That was the number that we were talking about a little bit ago, and that's the key pivot number. Below 1980 and then 72, there's literally nothing until you get to the 40s, 1944 to 1924 levels. So we're definitely seeing the patterns continue to confirm what's going on here. So let's go over and let's look at some other markets here. If I can get this up. Let me bring up the treasuries, and I mentioned on Monday that I thought that the treasury market would end up going higher. Probably need something bigger than a 1-minute graph. Let's go to the daily. And certainly VPM gave a buy signal on this on a daily about 5 or 6 days ago. We're at 285. 252 was the magic mark. I said if we got above there, then we were going to see the markets continue to go interest rates continue to go higher, and the target now is 262, 268. Above 268, it's bar the doors, because this thing is going to be on its run much higher. And like I said, we're going to find out when these events happen. They've already happened. I'm going to go over to the weekly basis here. Go look at a weekly chart, and you'll see. Before I jump off of this, the momentum, we're talking 0.7, a plus 0.70, 0.17, but the short-term indicator on the daily is really, really bullish and very strong trend. When we look at, we still have some negative trends out there on the weekly basis. So when I bring up the PPMs here, you'll see that we have, get this up here, you'll see that we have on, and get the right values. This one doesn't have an auto update, so I'll fix that in a second. But we're looking at 0.29, minus 0.29, 0.30, and 0.26. But we're above 245, 252 is that average. If we can close above there, that's going to be the magic. The long term, or on the 40-week moving average, is 2639, and I'm sorry, 264, we'll call it 2.639. So a break over 264 is going to set that tone, and we're heading for 272 plus. And like I said, we're going to find out what the real reaction to the market and the higher rates. And the Fed may be thinking they're in control, but I've seen this over the years. Once the markets decide rates are going higher, they will go higher, and the Fed will be the the tail will wag the dog during this time, and you'll see the markets will drive the markets. And typically in the past, the Fed has always been a laggard. They're always lagging what's going on in the market, and maybe, just maybe, we're going to end up in that same configuration as we used to be, where the Fed is reacting to the market, not the market's reacting to the Fed. And it, believe it or not, I know and since for the last 5 or 6 years, it certainly hasn't been that way. If you turn the clock back as many years I've been around, it never was that way before. The Fed may make a surprise move, but the markets, they were always responding to what happened in the marketplace, and that's certainly not the case today, but it maybe is beginning to be the case. And we've seen rates rise across the planet, actually. So even though in Europe the ECB is trying to do all these asset purchases and keep rates down, none of this stuff is working, by the way. So, I mean, you've got very moderate GDP growth across the planet. Things look a little better here, but there's other things that are happening other than the Fed that are getting some traction. But this is the thing. There's a thing, as they say. The thing is that sometimes when the good news comes and all the economy comes around, the old saying was that the market leads the economy by 6 months, 6 to 12 months. Well, this has maybe been the anticipation moving up to 2000 on the S&P, is that things were going to get better. And then when they do get better, it's the old thing, buy the rumor, sell the fact. And now that it's actually happening, it becomes really more of a, okay, that happened, what's next? And what's next is higher rates, the Fed getting out of the way. I really strongly believe that the Fed has been way out of their comfort zone for a long time, and if you look at their balance sheet, I haven't been able to find anything to prove what I'm about to say, but I really don't think it was legal that they bought mortgages like they did. I think they pressed the envelope, but it appears that government agencies and others the laws don't really matter, I guess. They just do whatever they want right now. So it's the Old West, and we're seeing that same thing happen in the Federal Reserve. So there's something I want to show you folks. I'm going to go offline here, and I've talked about this. I've been wanting to show these values for a while, but it's really a perspective. I want to bring out, this has to do with the interest rates. And what happens here is when we get here, I am going to show you, hopefully, of course it worked just fine a little bit ago, didn't it, Mitch?
Right.
It's one of those days. Here we go. I am actually showing you my iPhone, and I have an app on here. I don't want Bloomberg. I have an app on here called Economy, and it has some really interesting things on here from, and you can look at a number of things. And I want to show you the real estate. And this is when people are talking about the real estate, recovery. I always wonder. I always wonder where they're getting their information here. I'm just trying to find it here. Of course, here we go. I want you to look at I'm going to go to a max chart here. This right here, this chart here is what the housing looks like. This goes back to 1959, and you'll see the collapse obviously down to 09, and the recovery has gotten us back to levels on single-family housing units. The big boom has been on multifamily. I don't think they have a multifamily view, but if this is a recovery, boy, we got some big issues. I'm going to bring up the Case-Shiller. Now, prices have recovered a fair amount, not nearly back to where we were, but prices have recovered, and they have recovered in certain segments of the market. But this, to me, shows that we're at. Let me turn this app up. I'll tell you the exact numbers. We're at 656,000 here, and you can see it's up 8.3% from June 14, but we're looking to increase year over year at 10%. That all sounds good, but when you collapse 80%, it takes a long time to get back to even. And this just isn't the type of thing that you expect to see going forward. There's a section here on prices. This is a good app. It's called Economic Indicators. It's an iPhone app. They probably have it on Android as well. They have a section on prices, if I can find it. And I thought this was one of the things. CPI is sort of like I don't know what you call it. Just kind of keeps going up. If I don't find it, I'm going to move on here. What the other nice thing about this particular app, you can go by state as well. So you can look at every state stats and you can see exactly what's going on here. But this job openings, interest rates, come on, housing sector, there's a section that says pricing. I'm not going to see it, so we're going to go off this thing, I believe. When I get to the top, yeah, I'm not finding it. So the bottom line is that this thing is, I just have to turn that off and we're back to the screen, but the recovery is just not there, and I don't see that it's going to be there as far as the markets go. And by the way, if you ever want to show your phone like I just did, it's called Reflector. What was the name of that company, Mitch?
Air Squirrels, yeah.
Air Squirrels, and it'll work on PC. And if you have a Mac, then you already know AirPlay. You can do all that stuff anyway. So, but it uses AirPlay on your phone. But you can there's also an Android device as well that you can do. It's pretty cool stuff. So let's go and talk about some of this deflationary issues that we were talking about that I've been kind of harping on, and let's take a look. And of course, being an old commodity broker, starting in the world as a commodity broker, this is a very interesting chart here, and I'm going to throw a monthly graph here. In fact, let me see if I have what I think I have. Yes, I do. I want to get rid of this so you can really see. This is monthly graph of soybeans, and this is a nearest future. But you can see, or soybeans, corn, and this stuff has just collapsed. Remember the big corn boom? Well, that's over. Everybody found out that biofuels were a joke when you figured out you could go do horizontal fracking and get all kinds of oil. So that game all went out the door. And you look at all of these commodities, and soybeans has went up quite a bit here, but you can see recently this collapse. But we start to get into some of the other stuff out there. We start to look at our favorite gold. You can see gold has rolled off its top. If this downward, this is the long-term stuff. I know we've talked about gold before. I'm going to get off screen so I'm out of the way on this thing. But we've talked about gold before, and there's some pretty good support here. But if it doesn't hold right here, this thing's going back to $900 an ounce or something. 1,000 to 950 is going to be the target range. And this long-term moving average, I didn't really bring it up with the PPMs on it, but you can see it's vertically down, and there's a lot of resistance over this market. That's at 1348. So there's a ton of resistance, about 70, 80 bucks above this market. And all of these things, you can see all of these markets are. This is platinum. We can look at. Another market we know well is crude oil, and this, looking at its long term, here's the big spike that we had in 08, which and now you see this same consolidation. I mentioned in commentary the other day, the pattern is suggesting, let me just put this up here a little bit and spread it out. the pattern is suggesting that this market could go a whole nother leg down and retest these lows at $80 to $60 a barrel. And somebody was saying for every penny in a drop in gas that adds $1 billion into the economy. Well, there's so many trillions, it's a drop in the bucket. You know, it's the bulls are always grasping onto something to make it sound bullish. And while it's certainly a help, it's not going to be life changing on a big scale thing. There's certain segments of society that obviously it would be helpful to have 40 cents less a gallon. But for this particular pattern is a very negative pattern, and we've got numbers around the 85 level. If it gets through there, there's nothing below this market. My guess is you have to retest this low, and when that happens, you're at $60. And what crude oil, in my opinion, is telling us is a demand issue. There's a massive amount of deflation starting to show up in China and across Europe. That's what the ECB is worried about. They're worried about a deflationary pattern. We still have some moderate inflation here. We don't really have some of those things happening. I think it wasn't Portugal. It was some small South American country. I saw they're lowering their rates, trying to get inflation to come back. And the realities are is that and I've been a deflationist for years. When the '08 situation happened, it was generally believed that all this money pumping was going to be inflationary, and I don't believe that's the case. I believe there's deflation that is still driving the markets. And while the Feds, when the air comes out of whatever they put in, I think it gets much, much worse, and I don't think it's controllable. So looking out 5-10 years from now, you're looking at, I think, some pretty strong deflationary forces. And it comes down as a way it always does, is everybody wakes up one morning and says, oh my, when did this happen? And then you get the big reaction out of the market. But this crude oil chart to me is there. This wedge that we have here, let me just draw this in, I think is significant from a technical standpoint. So we get this typically these patterns. When you get a big drop like this, we're going to test these lows, and if they break through, then we're going to test this low. And I certainly don't think we're going to get back. I remember in 1986 when the markets when crude oil was $10 a barrel. That's dating myself, but there was not. It felt like it was free. Maybe gas was maybe 90 cents a gallon then. But the bottom line is this pattern is pretty negative, and typically you'll get out of this, you'll get one more leg down, and then when you get this, then there'll be some. I'm not sure what will happen after that, but this to me is portraying this deflationary scenario. I mentioned that I think in commentary that we would go over the Dow, so I'm going to bring up the Dow index as well very quickly here. And keep flowing. The Dow index, for the first time, is coming out of the top end of the pattern, but we're getting right at resistance levels right now. Let me make this full screen, and let me get out of the way. And in a minute, we'll talk about. I don't know if that ding is coming across or not. Let me get out of the way here so I can look at this chart. But here's the Dow index. The Dow has been out of favor a long time. This is when back in the 80s. It's interesting. 1981 through 86 was the height of the Ronald Reagan days, and you can see the U.S. dollar was screaming at that point. Then we came into the 87 crash, and since then it's been the great depreciation of the dollar, and now we went from $1.60, so we're about 50% off the value of what it was at the peak here. And this is starting to come up, and the talk is that, and there is an effect here, that the U.S. dollar being stronger is actually pushing some of these commodity prices down, but it's not going to push them down that much. Maybe in gold it's more speculative. When you get to crude oil, it's about demand, and I know the Saudis just lowered their demand targets, and production is high. There's more oil than there's ever been. You think about what's happened here in the United States, and if they turn, they turned these guys loose here in the States, we were already, I think we're a year and a half or 2 years from being the largest oil producer on the planet all of a sudden. So we could be totally independent of that pretty quickly in the next 5 to 10 years. And but the Dow is still somewhat of a safe haven. I don't think I'm not sure what's going on with why the cash flows. Probably mostly because of the differentials in interest rates. And if rates start to drive, then the dollar is going to get stronger. And we're talking just a minute ago about treasuries going up to 270 plus. That happens, the dollar is going to have a really strong bid in it. Is once again, if the dollar is advancing and the yields are still better than they are other places, you're going to see this type of activity go on. So, Mitch, were you able to run down some of those indexes and stuff we could take a look at?
Yeah, let's start with one of the ones that we use in a couple different premier portfolios. DBC is a commodity index that we often use.
Okay, let me. This one is linked up, so DBC, right?
Yes, sir.
So yeah, so let's take a look at some of these commodity indexes here, and you can see they're declining as well. There's some Fibonacci projections coming right now out of the Market Mind tool, and we're right at these lower levels of this index we've been, and we've talked about this before from the standpoint of putting these type of instruments inside. This is a monthly graph, so we'll go to the weekly in a minute, but putting these type of things inside of a portfolio, what it's going to force you to do, well, it's theoretically a great hedge. In times like right now, all it is a it's a placeholder, and you're going to end up with more cash in your portfolios than maybe you want. Right now, we don't own a lot anyway, but it can affect you in times like 2013 and stuff. You can see this index moved up a little bit. Let's go over to the weekly graph just to be able to look at that. So you can see we had a position, we got out. There's been a lot of different patterns that are unfolding here, but this thing is definitely, we're minus 0.83, minus 3.0 on behind. This stuff is right behind me here, and minus 0.09. So we're looking at major downtrend in this commodity index. Was there other specific commodities, Mitch, that we can bring up?
Well, we already touched on gold. One of the ones that was often cited not too long ago was silver, so I thought it might be good to pull up a SLV, silver ETF on that one.
Yeah. Yeah, I'm going to take off the strategies for a second here just so we can get rid of that stuff. All right, so now so you can see here we've got we're right at the extremes, or getting close to it, on the extremes of the downward targets here on this index. But this has been under pressure since 11, and yes, it is an industrial metal. Yes, there is other demands for silver, but even then, it's not that good. One of the markets I did want. Did you happen to find a copper index by chance?
Yeah, I do have that one. It's,
I want to look at that.
Okay. That ticker is CU.
So talk about an industrial metal. This is it right here, and this is the weekly basis. I'll spread this out a little bit. But this thing is, a lot of these markets are trading at 14, 16 months lows. We're seeing China start to lose a lot of momentum. There's just not a lot of demand for some of these industrial commodities, and in the great reinflation of the markets after the crisis, and all the efforts of the central banks, spending by the governments, all this to try to pump the economy, it probably has at least kept it flat. And the problem is, when you start to get to $18 trillion debts, it's pretty hard to keep pumping those monies, and the Federal Reserve to continue to create money at the level to keep money velocity growing. So there's ultimately, I think, a train wreck at the end of this thing, and it certainly is going to have to be some rebalancing from just about everything within the economy, the excesses that have been created by this situation. It's sort of like it always is. You're pushing things one way to fix one thing, and then something else breaks while you're doing that. So you never can actually get ahead. In the end, most likely what would have been best would have been more painful, but the pain would have been quick and over, is just to let a lot of these banks just fail, and the bailouts and all those things probably weren't necessary. That debate will go on forever, and we'll never know what it was like because we didn't do that. So we did something different. Well, what we will find out is the aftermath of all these things, and we've already been since '08. We're looking at 6 years now, getting on 6 years, and the reality is this is probably, and I remember saying this back in '08. This is going to affect the economies for 15, 20 years after this, and it just like it was. Maybe we put the Great Recession. We didn't hit the Depression numbers, but we definitely hit the some numbers that will have a similar effect. We're talking about 30 some years to get out of the Great Depression, and so we've got other issues though. Let's face it, we've got a lot of social programs, a lot of things going on, immigration here in this country, all of the stuff that is going to affect what's ultimately going to happen here. So there's plenty going on, but copper is flat. There is some. It's really the underlying trend here is got some support. We're 0.33 and 0.30 plus on ppm 2 and 3. So we have some underlying support here at some of these moving averages. Let me get the values up here real quick. And we're looking at 2330 on this index, and the supports are 2392, 2295. So we're right into the support range right now with rising moving averages in trend mode. So it's not going down a lot. So the crude oil is probably the one that has the most incremental real-time demand in the economy, and that's probably the one that's really reflecting the most as it is. So what now?
Last one I thought we could touch upon would be the DBA ticker. That's the agricultural ETF commodities. So that is a nice composite on that one. That one we're currently long as well.
Okay. Yeah, I've got some other settings on the system right now, so we'll leave that right now. What model are we on this?
3.2 weekly.
3.2 weekly. Okay. That one might work, but let's. So anyway, what we've seen is, when did we buy that, Mitch? You got that up?
We've held this position for some time. We got in back in February 3rd of this year.
Okay, so on this little rally, so it's just holding here. And
Yeah,
3.2 has the patience of I don't know what has a lot of patience. 3.2 has it. It's got not only patience, but there's some underlying momentum. PPM. There's a PPM 4 that's not on here, and should you embrace? We haven't talked about market mind. Maybe we'll finish the show here after doing this. Just talk about a couple of things we got coming out here, and the PPM. The PPM 4 is on an 89 period moving average. 89 is a Fibonacci number. It's been in the system for a long time, so it's a very long moving average, and that it will drive the momentum. It has a tendency for it to wait longer to get into trades because it wants to see more of a bottoming pattern, because it takes longer for that 89 period moving average to show the right characteristics. So anytime 3.2 is in play, there's one other indicator that's not showing, and it was too cluttered on the old BPM 2.0 to add that in. So it's but the three PPMs you can see on the PPM 3 is upward sloping, and there is some upward pressure, but very, very little. It's 0.15. Everything else is minus 0.53 and minus 0.37, so pretty down on that. I guess wonder if let me go off screen for a minute, Mitch. I'll take us off. I want to see if I can bring up something. Mitch, why don't you talk about a little bit what we did with the Twitter account, our new Twitter account.
So what we did, we just got it up and running yesterday, is we set up a fresh Twitter account based off of MarketMind. And what this will do is this will send out tweets as they occur around each of the different support and resistance levels. So every day around the S&P 500, we put out these support and resistance levels. And what we've now done is we've set up this brand new MarketMind Twitter account so that as we penetrate these levels, system will check, and within a minute we'll alert you via Twitter whether or not we've penetrated these levels. And so as the day goes on, you'll be able to see live as we interact with these different levels.
Yeah, and what I'm doing right now, I'm trying to put this together. I'm trying to get signed in here. I should have had you do this, Mitch. I'm going to set something up here real quick. Sorry, folks. I wasn't ready for that. This show today has been kind of out of sorts here.
Yeah, I guess even our stream is ready for the weekend or something.
I guess it's. But anyway, had some things with the background sound and those type of things that were bad. But anyway, I'll show you the screen here. We'll go back over to the screen here just so you can see it. I don't have it logged in just yet, but we have right now. Mitch, I was going to try to get you signed in so you could go ahead and log in there. Can you log in yet? It's not working. All right, folks, this is a disaster. So let me tell you what's going on here. The MarketMind, if you find MarketMind VPM out there on Twitter, if you're a current subscriber, we will go ahead and accept to follow us. And what you're going to get is tweets that come right out of our software when our key levels are broken. Ultimately, there's going to be other types of trade signals and other things that come out on that Twitter account. So what happens is the software generates a number gets triggered, it sends out the tweet, and you'll be alerted to these market events as they happen. And this will be it's driven by software, so we're not doing anything. And we can put all types of alerts, some of these Fibonacci numbers and levels that get hit, you'll know about them. So it's a way to follow that, and it will be more related to the MarketMind product as we get that released. And I know we were talking about having it done. I'm hoping that on Monday we'll at least start to bring people in. We're getting some of the numbers from TradeStation on what you have to get from a trading standpoint to be able to get the product for free, so it doesn't cost you anything different. And we'll be announcing some minimal pricing that's around the product once we get that all done. But this is a service that I think you'll find really nice. Those of you that I've talked to that said, hey, I really used to like the tweets that used to go out all the time when levels were being penetrated. Well, this is what this is about. And ultimately we'll have it on, it'll get pretty cluttered if we're not careful, but it does put the symbol. We can do multiple symbols, all types of stuff. So we'll be a little better prepared on Monday to show you what's going on here as far as that goes. And as typical, with 2 minutes to go here, I'm going to go back in and we'll do a final review of what the expectations for the close is, see what's happened since we left. And nice thing is it's 1986.40 now, and we're down 11 handles on the day. And as I mentioned, this low pattern coming in, actually I thought it was, it's this next hour, but we're even with these further declines, we're not really getting the market to break down a lot more. I just went over to the webs here, which is the 1 minute S&P futures, and one of the things once we get the MarketMind on the street, we're gonna start something called Market Warriors. We had Process Warriors, now we're gonna have Market Warriors, and that'll be a complete educational technical class that will show you how to use not just Market Mind itself and the indicators on there, but how to interpret, how to do a lot of technical. It'll be an hour show, and it's going to be really a technical kind of view. So if you want to learn about this stuff, how to do things, then that's going to be the place to go, and that will be starting to be offered in the next couple of weeks. There's a couple of things we have to do to get that done, but the Twitter service is there. So find Market Mind VPM and send us a request to follow us. We'll confirm you. Any of the, you have to be a subscriber to get on that service, but we will confirm you. I suspect most of the people around here are, and we'll be sending out some emails to that effect as well. Any last ideas or comments, Mitch, that I didn't cover?
No, I think we're going to continue watching the market and see if today looks more like a Monday or other days this week, like Tuesday, where we went through that weakness and rallied into the close.
Yeah, we're getting down pretty weak. We're 85.97 here as we coming into the close of the show, and there's a lot of pressure here. This looks a little different than how it's traded before. We spike early in the morning, and then we trade in the mid range, and then rally back in the end of the day. This one looks like nobody wants to hang around for the weekend. Anyway, folks, this is it. Thanks for showing up. Sorry for the few glitches we had today. We'll be better. We usually are. You got to have, I guess it's live TV, you got to have something go on once in a while. So anyway, have a great day, and we shall talk to you folks on Monday. Take care.